going to discuss about the objectives of financial management. See students, there are two objectives. There is primary objectives and the secondary objectives. Now see, the primary objective of financial management is to maximize the wealth of the shareholders. That is wealth maximization concept. What do you mean by wealth, students? Wealth means any valuable possession or money. So in accounting terms we called it as wealth. Now look here, the company has raised money from the shareholders. So the ultimate goal of the company is to maximize shareholders' wealth. If the company keeps on performing in a profitable manner on a consistent basis, the share price of the company will keep on increasing. You can do one thing, go and check when the Sensex was 1000 some 20 years back, what was the share price of a company, say Reliance or Tata Consultancy Services, when the company was still growing, and 20 years later, that is now, when the company has established a position in the market and it's expanding like anything. Okay, it is one of the most important companies of the world, remember. See, the business should focus on maximization of the shareholders' wealth, because the funds that we have raised belong to the shareholders, and the manner in which they have invested. Tomorrow, if I take the money from the shareholders and do not take wise decisions, then the money would get removed and I would earn losses, and shareholders would not be interested in investing the money and remove the money which they have already invested. So the returns earned by them determines their market value or the price. The returns have to be earned, and returns are determined by this share market price or value of the share. So you have to ensure that the money is invested wisely, and this will be shown through the movement in the share price of your company. Market price of equity share increases if the benefits from a decision exceed the cost involved. The market price of equity share will increase only if the investment in a particular project, that is the decision made in a particular project, it exceeds the cost that is involved. The money that you have put in, that you have poured in any particular project, and the cost involved thereof should exceed the returns. Market price of equity share increases if the benefits from a decision exceeds the cost involved. Let's say the company issued new shares. People invested in the issue. Shareholders came in. After some time, the money was invested in some project and the company made profits. So here what happened? The decision involved exceeded the cost which was involved. So the market price of an equity share will jump. All financial decisions should aim at ensuring that each decision is efficient and it adds some value. It has some value additions to the company. They should always keep on adding value to the profits of the company. This will help in increasing the market price in turn. So the market price of the share will in turn increase. How? If they are adding some profitability, ensuring some profitability in the decisions, as well as adding some kind of value. For example, if you take Reliance as an example, if Reliance company is investing in a particular project and there is some sentiment in the market relating to that particular project, that 80% of the work has been completed, and this is spread in the news, in the market, what will happen? The share price or the market price of the share will go up. So some kind of value has been added. If not profitability, at least the company has added some kind of a positive statement, some kind of a positive value or a sentiment to the company, and therefore the market price of the share has gone high or up, right? So these are the primary objectives that we discussed. Moving on to the secondary objectives. The very first is profit maximization or effective utilization of funds. Whatever funds you're getting, you must ensure that you're making effective utilization of those funds. Otherwise, it will result in higher cost as compared to the gains or money that you have invested in. Okay? The gains or money that you invest, availability of funds at reasonable cost. Coming to the second point, it should happen that it shouldn't happen that I'm taking a loan and the loan is available in the market at an interest rate available to a customer is 14%, for example, and because of some reason I have been charged at a higher interest rate than the market price. So then it's not a reasonable cost I'm paying for the funds that I'm procuring, right? So availability of funds should be ensured at reasonable cost or at an economic rate, right? Now, maintaining adequate liquidity. You should not be in a position wherein you don't have funds and there is a customer coming in and you don't even have the adequate funds to go and purchase raw material. You need to always maintain liquidity at all times, either in the form of liquid assets or liquid cash, so that you're not short of funds at any moment of time in running the day-to-day business. Coming to the next point, that is ensuring safety of funds. It means that you do not lose the funds by going in for wrong decisions or by trading in something which is harmful for the business. So ensuring safety of funds is very crucial, very important for any business. And lastly, avoiding idle finance. Whenever you have any finance which is not being used and is idle for some time, then you must invest it in some financial instruments wherein you can earn some interest. You can earn money on it for a shorter period of time instead of wasting the resources. So all the time, whatever fund you are making available for the business, ensure that you are avoiding the idleness of those funds. Okay, thank you.